Hello everyone. Today we are going to talk about IFRS 9 financial instruments. This would be in context of SBR, one of the P-level papers of ACCA, but you also could use this lecture for some other qualifications. Uh, we will be covering this in detail, but today it is just an introductory video about this standard. Alright, so So, what the definition of financial instrument is all about? This is any contract that gives rise to a financial asset of one entity and a financial liability or instrument or equity instrument of another entity, right? So, financial asset. So, it talks about financial asset as well as financial liability and equity as well. So financial asset, this could be financial asset, this could be cash for someone, and this cash, all right, this cash that someone is getting paid with, this is the financial asset for that entity, for that person, for that company, for that entity, whatever, however you're gonna say it, but this is the financial asset who is receiving that cash. All right. On the other hand, this could be financial liability to the one who is paying it. Just ignore the spelling mistakes, man. So it's no big deal. so so cash who is paying is the financial liability. The cash is the financial liability to that entity. So if you have debt, if you are the debtors, like you're gonna receive uh, payment for your service or for supply of goods, so this is financial asset. Like creditors, it is creditors. So you have to pay to the people or the entity uh, who you received your service or received goods. You need to pay them by cash. So this is the financial liability for you, right? So that's what financial asset. These are some of the examples of it, and I just try to explain the definition, how what it says. This is the any contract, and it has to be a contract. So if you think of investment, right? Investment, suppose you want to invest in ABC, then this is equity. This is equity for ABC, for ABC, right? So that's mainly the things the definition says. And like I wanted to say earlier is that this is a contract. This has to be a contract, like enforceable by law, right? So if there is no contract, then there is nothing. There is no obligation to pay. And if there is no contract, then this, you cannot say that you have any financial asset or financial liability. There is no rise of financial asset or financial liability, or there is no equity. So but it has to be a contract. So this is what this definition is. So this is any contract that gives rise to financial asset of one entity and a financial liability or equity instrument of another entity. So right. So let's talk about financial liability first. Why this standard is important? Right? You have to understand what is your financial liability and what is your financial asset or what is equity. You have to distinguish between them because because uh, gearing depends your gearing ratio, your debt equity ratio depends on how you distinguish them, because you cannot like say this is one, this is your debt when it is your equity, or it is your when it is your debt but you're considering this is equity. That's why it is important to know, because debt equity ratio is very it depends. Like many banks, when they're giving you loans or shareholders, it is important to them to understand what the debt situation is for a company, or how is the equity. So this is very important. That's why this standard uh, talks about how you're gonna identify, how you're gonna recognize financial liability, equity, financial asset. So this is the thing. So this is what this standard is. So IFRS 32 talks about the definition, and IFRS 9 talks about the accounting treatment of this financial asset, liability, equity. So going to continue doing that. So this is mainly the definition part. Talks IS 32 talks about the definition of financial asset, definition of financial liability, equity, all those kind of definition that you're gonna see. So let's talk about financial liability. This is when you have to consider these 3 points to have financial liability. So you have to understand these 3 points. These 3 points, when you have this one of these 3 points, then this is financial liability. So a contractual obligation to deliver cash or another asset to another entity. So what what does it mean actually? So let's talk about financial liability. The first point was that contractual obligation to deliver cash or another asset to another entity. Right. So suppose your company, suppose ABC Limited wants to raise finance externally, right? Externally, it is issuing debentures, preference shares. Example, I'm just giving examples, or it is like loan, some kind of loan they want to raise their finance. So in years time, in some time, these are the obligation. All right, these are the contractual obligation that they need to settle in the future, and they have to pay it by cash. So if this arise, if they have this obligation to redeem these debentures, these preference shares, it is the redemption. All right, they have to redeem. So let's say this is redeemable. Preference share is also redeemable. All right. So redeemable with cash. So this is financial liability for ABC. And also, if you think that they are not paying cash, right? They are not paying cash. They have no way of paying cash, but they are. So this is an obligation when they have to pay you by cash. But what if cash isn't an option? They cannot pay you by cash. But so in situation like that, they will pay you with like shares. They have to deliver. They have to issue ordinary shares, issuing ordinary shares, right? So this is another financial instrument. So this is also another financial asset, right? So this is what uh, number one point is. So another thing is that number two, if you think so 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 number two in the list is the contractual obligation to exchange financial instruments with another entity under conditions that are potentially unfavorable. Potentially unfavorable. What is actually this is? They talks about derivatives. So derivatives is nothing but something that you have to settle in the future. Settle in the future, like you're placing bet with your friend that XYZ share will be 100,000 in 1 year's time. All right, but your friend says this will be less than. Suppose you say that this will, your friend says this will not go beyond $100. It will stay as 95 $95. All right. So this is the bet. So if you lose, if you lose, if your friends win, or if you lose, then this you have to pay him like $10,000, right? So this is derivatives. This is about the future settlement. You don't have to pay anyone anything, but all the settlements are done in the future. So if the share price, if your friends win, if the share price stays less than 100, then you're paying your friend $100,000, right? So so this is the unfavorable position you are in. So potentially unfavorable. So it says that the contractual obligation to exchange financial instruments with another entity, okay, under conditions that are potentially unfavorable. So unfavorable, this is you're not going to win. If it is favorable, then you can it wouldn't be a financial liability for you. It would be financial asset. Then this potential talks about future, it is potentially you can have unfavorable situation on your side. All right. So so this is mainly the things, the derivatives. This is the main concept of derivatives. If you struggle to understand, then this is nothing but some bet, some you're anticipating for the future. Suppose it's gonna rain in in 2 months time, you're talking about that, but someone is not agreeing with you, so you place that bet. So that thing, that amount is the derivatives, and if you lose that amount, then this is the financial liability. So this hundred this $1,000 that you place your bet with your friend is your financial liability right now. So number three, let's talk about number three. A non-derivative contract for which the entity is or may be obliged to deliver a variable number of entities own equity instrument. So this is obligation as well. An entity has to deliver variable number of entities own equity instruments like shares or some ordinary shares. So to understand this point, we have to discuss this 2 point as well. This one, right? Let me highlight this point as well as this point. All right. So you have to understand this. So convertible into variable number of equity shares of entity, then financial liability. What is meant by this? So convertible into variable number of equity shares of entity. So let's take this example. A Limited is required to settle its debentures of rupees 10 lakhs. So to, this is just some number, all right? 10 lakhs, you can say 100,000, you can say anything, 100,000 dollars or anything. This is just the currency, all right? So A Limited is required to settle its debenture of rupees 10 lakhs by issuing its own equity shares worth rupees 10 lakhs after 1 year. So in 1 year's time, all right, the debentures that needs to be settled worth of 10 lakhs, this has to be done by issuing equity shares that is of 10 lakhs after 1 year, right? So number of shares depends on the fair value of the of share after 1 year. Variable number of shares, example, variable number of shares, it is FL. So what actually this says, that conversion of conversion of shares, conversion of debenture, all right, debenture to equity shares, but we don't know how many shares we have to convert, right? It could be anything, so it is variable number of shares, variable number of shares. So how many shares in 1 year time, we have no idea, and it depends on the fair value of the share after 1 year, right? Fair value of the share, it could be anything in 1 year, like rupees 10 lakh share is the, if you have like 10, if you have like 100, so the fair value of shares in 1 year could be anything. So suppose, like, if you take this example, rupees 10 lakhs, or how many shares you will give in 1 year? 10. Suppose you are giving 10 lakhs. Total amount of the share is 10 lakhs, all right, and then per share is 100 rupees 100. So 10,000 shares, all right, 10,000 shares you're giving, but in 1 year's time. Or if it is again 10 lakh, right, rupees 10, rupees 10, 10 lakh, but this time we're anticipating that this share would be rupees 110 per share. So much how many shares you will issue, like suppose 9,000 shares, right? Suppose 9,000 shares. So this is variable. You don't know exactly how many shares this time. You have said, if you have already announced it, but you don't know actually what the number of shares would be. So it would vary depending on the fair value. These are the fair value. This $100 is the fair value, this $110 is the fair value, and it depends on this fair value the number of shares that you're going to issue. So if it happens like that, then this is financial liability. All right, this is financial liability. And if the conversion into fixed number of equity share of entity, then this is equity. So this debenture that we are talking about, conversion of debenture to equity share, right? But we now know that the number of equity share should be fixed. There is no ifs and buts. You're gonna issue, for sure you will, ABC company will issue 10,000 shares. No matter what the fair value is, no matter what it is fixed. The number of share is fixed. So this in another terminology, it says, it is the terminology for this is fixed for fixed test. You could use this terminology, but it is some fancy words they use, so you can keep it in your mind. So if it happens like that, all right, so say L Limited is required to settle its debentures of rupees 10 lakhs by the issue of own 15,000 equity shares. Okay, its own 15,000 equity shares, right? So number of shares are fixed. So it says in bracket that number of shares in fixed is fixed. So this is fixed for fixed test. This is, and if the scenario says something about this, then you have to consider this is equity, not financial liability, but this is an equity instrument. Remember, so let's go to some test your understanding, some questions, some little questions. All right, so test your understanding. One, liability or equity. We have to distinguish what is, if it is liability or if it is equity. So Costers wishes to purchase a new ride for its animation Galaxy theme park, but requires extra funding. All right, so they have to purchase this animation Galaxy theme park, but they need extra funding. All right, on 30th September 2023, whatever you want to say the date. All right, so 30th September 2003, Coster issued the following preference shares: 1 million preference shares. So in order to raise finance, sorry about the line, man. Sorry about the line. So 1 million preference shares they have issued for $3 each. No dividends are payable. Coster will redeem the preference shares in 3 years' time by issuing ordinary shares worth 3 million. Alright? The exact number of ordinary shares issuable will be based on their fair value on 30th September 2006. After 3 years, the number of shares that they will issue, the ordinary share, their own equity instrument, this will vary. This will vary on the fair value. Fair value on 30th September 2006. So we have already learned that the variable, if it is the variable number of shares, that your own share that you have to give, you don't know that yet, it depends on the fair value, then this is what, this is your financial liability. All right, this is your financial liability, this point. So it's easy, you can you easily understand it. You can clearly read this line and you can understand that this will be your financial liability. So on number 2, 2 million preference shares for $2.8 each, $80. No dividends are payable. The preference shares will be redeemed in 2 years' time by issuing 3 million ordinary shares. So they are issuing 2 million preference shares. All right, so 2 million into 2.8 is 5.6 million. All right, so test your understanding. Here is, okay, we don't need to work this out, you can just read it. So 2 million into 2.80 gives you 5.6 million million worth of shares. So no dividends are payable. There will be no dividend. The preference share will be redeemed in 2 years' time by issuing 3 million ordinary shares. In 2 years' time, this 3 million ordinary share will be issued for for total number of shares, which is 5.6 million. Alright, $5.6 million. So this 3 million will be issued. So tell me if it is financial liability or equity. You exactly know the fixed number of shares, which is 3 million ordinary shares, that you have to you that this what this coster has to issue. So it is fixed. It passes the fixed for fixed test. So this is equity instrument. Right. So let's get to this third point. 4 million preference shares for 2.5 each, 2.50. They are not so 4 million. So let's get to number 3. 4 million preference shares for 2.550 each. They are not mandatorily redeemable. Alright. So see, the point is mandatorily redeemable. Right, mandatorily redeemable. A dividend is payable if and only if dividends are paid on ordinary shares. You also, so first thing that you read is the mandatory. It is not redeemable. It is not mandatorily redeemable. You don't have to redeem. There is no such thing. So it is not your liability anymore. And another thing is that a dividend is payable if and only if dividends are paid on ordinary shares. So if you pay dividend on ordinary shares, only then you can pay dividends on this preference share. So you have linked, this coster has made the dividends of preference share depends on the dividends of ordinary shares, right? So in your mind, I hope this is nothing but equity instrument. This is not equity. All right, this is not any liability, nothing. This is just simply equity instrument because it is not redeemable. You are not obliged. There has to be able to recognize something as financial liability, there has to be an obligation, right? So let's see the answers. So first point, 1 million preference share. The definition of a financial liability includes any contract that may be settled in a variable number of the entity's own equity instruments. All right, third point. Talking about third point, you can read this, and if the concept is clear, you will clearly understand this. So therefore, a contract that requires entity to deliver as many of the entity's own equity shares, equity instruments are equal in value to a certain amount should be treated as debt. All right. So so talking about this variable number, so it has to be debt. Hoster must redeem the first set of preference share by issuing ordinary shares equal to the value of 3 million. The 3 million received from preference share issue should be classified as a liability on the financial position, right? So 2 million. So let's talk about 2 million preference share. A contract that will be settled by entity deliver a fixed number of its own equity instrument is an equity instrument. See, this is recognized as, this is classified as equity instrument. Hoster will redeem the second preference share issue with a fixed number of ordinary shares, which is 3 million. See, we have learned that 3 million ordinary share will be issued for the value of $5.6 million. From the second preference share issue should be classified as equity in the statement of financial position. See? So 4 million preference shares. A financial liability exists if there is a contractual obligation to deliver cash or another financial asset. there is no obligation for poster to repay this instrument. No obligation. Alright? There is no obligation. Dividends are only payable if they are also paid on ordinary shares. That's what we have talked about earlier. The dividends are depends on the dividends of ordinary shares. There is no obligation to pay dividends on ordinary shares. So see, companies don't have the obligation to pay dividends on ordinary shares. All right, they could do it if they feel like. So there is no obligation to pay dividends on these preferred shares as well. So this instrument is not a financial liability. The proceed from the preferred share issue should therefore be classified as equity in the statement of financial position. That's it. You can read this, and if you understand the concept, it will be very clear to you. Let's talk about some other points, a little bit of some other points, right? So, settlement alternative, take my shares or cash. If it is convertible, all right, okay, we will make some other videos for this one, right? It is already getting quite a lot. uh, I'll be making another video on this, the very short video very soon. Okay, so see you guys. Thank you.